Most people know the stock market is one of the most powerful tools for building wealth, but very few people actually understand how it works. And that's a problem, because when you don't understand something, you either avoid it completely, or you make emotional decisions that cost you money. By the end of this video, you'll understand how the stock market really works in simple terms, where it came from, and how people actually build long-term wealth from it. Without hype, without jargon, this is Budget and Build. Let's break it down. Why the stock market was created. To understand how the market works today, we need to look at why it was created in the first place. Hundreds of years ago, building anything large was incredibly expensive. Ships, trading routes, factories, no single person could fund those projects alone. Back in the 1600s, sending a ship across the ocean was one of the riskiest businesses on Earth. Storms, disease, pirates, entire voyages could be wiped out overnight. So merchants came up with a simple idea. Instead of one person funding everything, what if many people each funded a small piece? If the journey failed, everyone lost a little. If it succeeded, everyone shared the reward. That structure became the first corporations, and in 1602, the Dutch East India Company became one of the first businesses to sell shares to the public, meaning everyday people could own a piece of a business and benefit from its success. That idea changed the world. It allowed risk to be spread capital to move faster and entire industries to be built. And that's how the stock market was born. What a stock actually is. At its core, a stock is simply a piece of ownership in a business. If you start a company by yourself, you own 100% of it. If you start it with 3 friends, you each own 25%. Public companies work the same way, except their ownership is split into millions or even billions of tiny pieces called shares. When you buy a share of a company like Apple, Amazon or Tesla, you're buying a tiny slice of ownership, a claim on future profits, and a vote of confidence in that company's future. You don't run the company, you don't make decisions, but you do benefit when the business grows. Why companies sell their shares? So why do companies allow the public to buy pieces of them? Because it lets them raise massive amounts of money without taking on debt, instead of borrowing from banks issuing loans or using only internal profits. They can sell shares to investors and use that capital to build factories, hire staff, develop products, to expand globally. This process is called going public, and it's how a company lists on the stock exchange. In return, investors get ownership and the chance to benefit if the business succeeds. How stock prices are actually set. This is one of the most misunderstood parts of the stock market. A company does not set its own share price. Prices are decided by 2 forces: supply and demand. If more people want to buy a share than sell it, the price rises. If more people want to sell than buy, the price falls. That's it. Which means a share price doesn't just reflect how profitable a company is today, it also reflects expectations, fear optimism, headlines, future potential. This is why markets can rise even when profits are weak, and fall even when businesses are strong. The stock market isn't a scoreboard of today. It's a prediction machine trying to price in tomorrow. Why investors buy unprofitable companies? This is where many people get confused. Some of the biggest companies in the world were unprofitable for years. Amazon lost money for most of its early life. Tesla didn't become consistently profitable for a decade. Uber lost money for years after going public, yet investors still bought their shares. Why? Because the stock market prices future potential, not just current results. Investors weren't buying what those companies were. They were buying what they believed those companies would become. Sometimes that belief pays off, sometimes it doesn't. That's the risk. Why the stock market affects everyone. Even if you've never bought a stock in your life, the market still affects you every single day. When markets rise, businesses expand, hiring increases, investment flows, innovation accelerates. When markets fall, budgets are cut, jobs disappear, economies slow. Your pension, workplace retirement plan, savings insurance funds are all tied to the stock market in some way. Even the phone you're watching this on, the food you eat, and the job you work in likely exists because stock market capital funded it. The market is the engine that allows millions of small investors to build things no single person ever could alone. So, how do people actually make money from the stock market? There are 3 main roles people play. 1. Long-term owners. These people buy shares in strong businesses and hold them for years or decades. They benefit from rising share prices, dividend payments, long-term compounding. This is the most boring approach, and historically, the most reliable. 2. Traders and speculators. These investors try to buy shares when they're cheap and sell them when prices rise. They're betting on market psychology, trends, fear and greed. Some do very well, many lose money. Most underestimate how difficult this actually is. 3. Founders. These are the people who build companies from the ground up. They own large portions of their businesses, so when a company succeeds, their net worth rises dramatically. It's the highest upside and also the highest personal risk. The real truth about getting rich from the market. There is no single formula, but every path shares the same foundation: patience, discipline, risk management, long-term thinking. Wealth in the stock market rarely comes from one big win. It comes from years of consistent decisions that compound quietly in the background. The market rewards time, consistency, and emotional control, much more than intelligence. Final thought. At the end of the day, the stock market is just a mirror. It reflects how people feel about the future, where capital is flowing, and what the world is trying to build next. And if you want to benefit from that future, you don't have to predict it perfectly. You just have to start participating in it, slowly, consistently, and with a plan. This is Budget and Build. If you found this useful, consider subscribing, and I'll see you in the next one.